Well, hello there. Welcome back to the Confident Retirement Podcast brought to you by LPF Advisors. I'm your host, Chris Flammy, and join me are my usual sidekicks and fellow resident advisors, Armando and Colin. Hey, guys.
Hey, how you doing?
Spring has sprung here in Florida. It's a little warmer. We got our short sleeves on, and we don't have our pullovers or our quarter zips or our jackets. It's starting to warm up, and we're going to get cooking today on our Henry series. We're continuing what we've done. We started this a couple of weeks ago, designed specifically for Henrys. That's a high earner, not rich yet. And if you're making a solid income, but you don't feel like you've got total control over where your financial picture is yet, you're in the right place. You got three of us here. We're going to help you with that. So we're discussing the most common financial planning challenges faced by Henrys and how to overcome them. This week, we're diving into how high earners often have the capacity to invest more, to put more aside, but may lack the knowledge around where and how to do it. So that's where we'll dive in on this week's episode. But first, let me do the quick disclaimer. The information we provide is our opinion, not necessarily that of our firm or platform. We provide general information only on the podcast and not any customized investment advice. Nothing should be construed as financial, tax, or legal advice. You should consult with your own professionals about your personal situation. All right, Colin, let's jump in.
Chris, thank you for the introduction. Armando, so I feel like I have the capacity to invest more, but how do I know what's right for me when it comes to risk taking?
Yeah, Colin. To me, understanding your risk tolerance is a key part of developing a sound investment strategy. Your risk tolerance reflects how much risk you're comfortable taking with your investments, and it's important to balance that with your financial goals and time horizon. I like using the three-bucket approach to help determine what investments or products I should use for each goal.
That's interesting. So what is that? What's the three-bucket approach, Armando?
Yeah, you can put it like this. So take all of your financial goals, whether that is saving for a house or retirement, and assign them to three buckets. Bucket one will be short term. So think anything within the next 3 to 5 years that you're working on. Bucket two will be intermediate. So anything you're trying to accomplish in 5 to 10 years. Bucket three will be long term, that being anything 10 plus years from now. The shorter the time period, the more conservative you should be, and vice versa. Say, for instance, you want to buy a house within the next couple of years. We would definitely want to keep that money in a risk-free product because we know that every dollar counts toward this goal.
So which investments or type of accounts should I be putting money into for short-term goals?
Yeah, products that are suitable for goals like bucket one would be high yield savings account, certificate of deposits, or treasury bills. Anything that can protect your principal and get you some interest. If you choose to do a CD, make sure you have money set aside just in case an opportunity comes up during the term of the CD, or simply line the CD maturity up with your expected time horizon.
What about the third bucket, the long-term goals for retirement? Where should that be?
Yeah, so third bucket, any goal that is, 10 or more years. So that could be a mixture of exchange traded funds, mutual funds, or individual stocks. Anything with equity so that has room for growth. That exact mix is unique to each person and their risk tolerance, goal and time horizon. With more time, we can allow fluctuations to happen in our investments without feeling pressure because if they go down temporary, it has time to recover.
Gotcha. I gotcha. So should we do those investments in a retirement account?
Yeah, Colin, these are all great questions. So yes, you definitely want to do these in retirement accounts. So yes, retirement accounts such as traditional or Roth IRAs and employer-sponsored plans like 401ks and 403bs are great tools for investing for retirement. Deciding which one you use depends on your individual situation. But if your company's sponsored plan offers a match, you definitely want to make sure you're taking advantage of that.
Okay. What's the benefit of using these retirement accounts?
Bingo. Yeah, this is most important question. Unlike a standard brokerage account where capital gains, interest, and dividends are taxed, these accounts that I mentioned allow for tax-deferred growth over the life of the account. You will be taxed, though, when you start to take withdrawals from your retirement accounts, unless you have made Roth contributions or after-tax contributions.
Gotcha. So you mentioned employer-sponsored plans. How should I leverage this in my strategy for saving for retirement?
Yeah, employer-sponsored plans are a great way to lower your taxable income, and they allow you to contribute more than you are able to in a traditional or Roth IRA because they have higher contribution limits. And like I mentioned before, they also allow, for most plans, allow employer matches, meaning that your employer will match up to a certain percentage of what you contribute. So you can basically consider this free money.
Everybody loves free money.
Exactly.
Aren't there certain restrictions for these retirement accounts?
Yes, of course. And that is very important to know these restrictions for each individual account. Most retirement accounts in general have penalties if you withdraw the money before reaching the age of 59 and a half. So if you're going to put money in these type of accounts, make sure you don't plan on using them until you reach that age or older.
Awesome. Okay, guys. And I know we didn't cover anything in bucket 2. We don't have time to do that today. We may do a different session on those. There's also some advanced tactics that we'll discuss in future episodes because sometimes the Henrys get in situations where they've made too much money and they can't contribute to a deductible IRA or a Roth because their income's too high. And there's some things we can do with the 401k, a concept called the backdoor Roth that works really well. And we'll dive into that in the future. So if anybody has more questions about this or any financial topics, you can feel free to reach out to us at lpfadvisors.com or email us using info@lpfadvisors.com. Be sure to subscribe if you like the episode, share it with somebody, and share it with people that you care about if you found it helpful. Thanks for tuning in. We'll see you next time. Until then, take care and be well. Thanks, guys.
Thank you.
You've been listening to the Confident Retirement Podcast with Chris and Mark from LPF Advisors. For more information on them and retiring confidently, please visit lpfadvisors.com. If your ears are pleased and your mind is now at ease, do share the program with your friends and subscribe wherever podcasts are found.